first question from the line of Amarnath Bhakat from Ministry of Finance of Oman. Please go ahead.
Yeah, hi. Am I audible?
Yes,
Yes,
please go
please go
ahead.
ahead.
Yeah. I just want to know this cash level which you are holding at the moment, close to 4,000 crore. What's the plan for this utilization? Because your capex requirement anyway is very less. How this cash is going to be utilized? Any plan for it?
So Amarnath, the 3,900 crore cash we have on our books, out of this approximately 1,500 crores we had prior to our strategic tie-up with the Reliance Group, and another 2,165 crores got infused as part of that particular strategic deal. At this point of time, one, we are focusing on our core business, which anyway is free cash flow generating. At the same time, there are certain new initiatives that we are pursuing. As you would appreciate, we operate in a very sort of disruptive sector, so to say. Uh, a part of this particular cash could get utilized in future towards promotion of our new initiatives, or if any other inorganic opportunities come along. At this point of time, we are ensuring that we get our core business back on track, and utilization of this particular cash on the balance sheet. Obviously, we will take stock as our new initiatives unfold.
Your company, yeah, as you correctly said, also this is a cash generating company. So the utilization of the cash to for your core business is really very limited. And after the Reliance money came into the business, and these are it's become a kind of an investment company, that managing the treasury, getting the return which is much lower than your business returns. Actually, it is hampering your return on capital employed on an overall business basis. So even if your business is growing high, because of that cash level, your ROC is getting contracted a lot. So unless you find out certain fruitful way to utilize this cash, maybe an inorganic or whatever company thing there, this will become an overhang for your return on capital, isn't it?
So yes, you are right that at this point of time, the major chunk of cash that sits that earns about whatever 7.5% kind of yield. So at this point of time, as I said, there are certain new initiatives in pipeline. Once we proceed over next few quarters, the company could sort of reassess the best utilization of this cash. At this point of time, we are ensuring that we don't do anything silly with this cash, so to say. And at the same time, whatever returns could be maximized on this particular treasury in the safest possible manner, that is being done.
If I could add to this point, Abhishek.
Yes, please go ahead.
Yeah, so when we were doing the deal last year with Reliance, we were around that time we were just limping back from COVID related disruptions. But our goals are much more ambitious, and Reliance with the Reliance strategic investment, our idea is to enter into many value added fields. So we felt at that time there is a need for capital, and that's how the money was infused into the company. But this quarter, if you see the last quarter, our strategies have yielded good results. We decided to focus on our core business, which is local search, because it was mission critical for us to put our systems in place, to overall see performance take off, because we have been highly profitable company. Yes, you are right. When with all this new money into the company, there's going to be a challenge on return of capital. But then you don't want to make a harakiri by throwing the money into some random business to acquire something. I strongly feel, with my 20 years, 25 years of experience in this business, the core business has tremendous strength, and it's a high cash flow, free cash flow business. And if we just stay focused for the next couple of quarters, we will see a huge return on existing, usually, huge return in terms of profitability. Yes, it'll no may be measurable to the capital that we have. Then we kind of rethink on our strategy, not rethink, and fine tune and see what are the new opportunities. That's how we are thinking right now, because it's important to keep our customers happy, the advertisers happy. You know, as you can see, this quarter we have grown our customer base by 25% from last year, and overall the business is in the right trajectory. These are technical points that you raised, but I would say gradually we'll address these issues. At least
Yeah,
better
Mani,
to have
I
a lot
asked
of
this question.
cash in the books than not have debt in your book.
Yeah, no, that's both the sides. Too much is not good. That is what the things are happening. Other side, when we think the company
I
or too
agree.
much of that is also not problem. That is a problem, and too much cash without 7-8%
I agree,
yielding,
sir.
where your business is
Yeah,
having 25% kind of ROC, is just
yeah.
diluting the Rocky. Anyway, so I have this two more strategic question. Operational things is very clear from your presentations as well as the business understanding. I have two more strategic questions. One is, see, you are developing so many products, two or three products are on the line,
Right.
which might be implemented or commercialized maybe another 2-3 quarters down the line. I'm just trying to understand the product what you are developing. It is already there in the market in some form. Whether it is travel related, whether it is business to business related, whether it is some product is already there in the market. I'm just trying to understand what Just Dial is trying to do to differentiate its product from what already in place. Whether it is Google for search engine, whether it is India Mart for the B2B business, whether it is travel related, hundreds of different kind of platforms are there. So, are you doing something which will differentiate yourself so the people will come to you, not to others?
Okay, so let's understand our business. Our business is to help small businesses get customers, okay, which has been for the last 25 years. And how we have been doing it, we have given that one point access to prospective users who are buyers who could find and discover and eventually find the right vendor for what they're looking for, and thereby we have been benefiting, you know. So that model cannot change. That remains that. So Just Dial will continue to be a platform which will generate quality leads for businesses. The big differentiator between us and the other players is, in our case, when a small or medium businesses or any business or service or whatever get acquire customers, that customer brings to them some, there is a lifetime value opportunity with that customer. Other than most other platforms where the customers are owned by the platform, these businesses happen to be just suppliers. Mm. So that, and if you think about, every small business want to become a medium sized business wants to become a large sized business one day. So they have to continue to have their own customer base and grow that base. So Just Dial plays a very important role in that. Now, for overall user experience, we may have to mimic some of the product's features which are there in various verticals. Because as a horizontal, Just Dial give a unique proposition, which is that you can find local vendors, in your neighborhood vendors for your products and services that you're looking for. In most cases, you will find names that are familiar to you, and you will be far more satisfied, buying from those familiar names. And now that the price difference is narrowing down between online and offline and all that, then the obvious loyalty, or rather not the loyalty, the faith is more on local vendors that I know of. But if I have a platform like Just Dial through which I can access those vendors, and as a user, I'm saying, I would prefer that. Now, why? Well, in that access, should that have ability to transact online? Should that have ability to fix an appointment online? Should that have ability to place an order online? भाई वो सब होना पड़ेगा. That only then the platform becomes relevant. So whatever we are doing in terms of product improvement, features and all that is only fine tuning to make it up to date. The basic principle of being a bridge between the buyer and the seller remains, and our job is to continuously help small medium businesses grow their customer base. But in that process, if there are requirements to have certain features, that is what we are working on.
So this association with the geo, the market looking at Just Dial is not just a Just Dial. At the moment, we are all looking at the Just Dial is a part of the Reliance Group. Now,
Right.
Geo with its vast kind of a network which they already built across the India. How does that is coming to Just Dial as a strategic things which will give them a competitive edge over any other competitors available in Indian market? This is exactly
Okay.
my question as I just try to hint directly to the point. How that Geo Association, now Geo is your owner of the company.
Right.
Of course,
Right.
when Reliance buys something, they doesn't buy for a small thing. They buy something for a huge kind of an growth outlook for over a longer period of time. Now, trying to
Right.
understand how that is a competitive advantage for you.
Okay. So first is there are certain natural things that come with the Geo partnership. Geo happens to be the largest cell phone provider in the country, almost in numbers. Now the business contact details, the business data that comes to Geo directly flows on to Just Dial. And that's further strengthening our database in terms of listing small medium businesses in the length and breadth from the length and breadth of the country. Then the second thing is, if you look at it, there are retailers which are geo partners. They also automatically come to our platform, and thereby we are able to enrich our content as well as our vendor base. Hmm? Then the third, of course, integrating Geo Reliance smart stores and platforms and all that. But let us tell you about the original thinking behind this strategy was how to get there was a kind of a regulatory thing that was happening where actually the government wanted to differentiate between a platform which is so what do you call third party marketplace different from first party marketplace. Now somehow that regulatory reform has not happened right now, so we have plans in place where the original plan was Just Dial becomes the third party marketplace, which is like the vendors are any of the local dealers and local manufacturer, whatever it is, and you directly as a customer buy from those pick and choose of vendors. And the other model was like a warehouse based model where it was first party marketplace. Basically, you then directly buy from a Reliance, Geo Mart, or Amazon, and whatever it is. So that since that change has not taken place and there's no immediate plans to do that, we said we would rather focus on a core business, more particularly because the core business was really hurt you know but yes,
Mm.
you will see in due course of time what you said precisely will happen. The big plans, the big picture, it's not going to be a small business, but with the right time, this will happen.
Thank you very much. I will join the queue for further question. Thank you.
Thank you.
Thank you. We have a next question from the line of Nikhil Chaudhary from Nuvama. Please go ahead.
Hi, can you hear me?
Yes.
Yes,
Sure.
please go ahead.
Thank you for giving me opportunity and congrats on good numbers. So just one thing I want to understand, especially related to intangible under development, uh, how that is progressing. Basically, are we still capitalizing at the same run rate? And how long do we plan to do that? Is it going to be in next FY24 as well? And when do we expect that capitalization to hit our income statement? Basically, when we are thinking of monetizing those assets, all three, JD Expert, and JD Commerce and JD Reality. So just want to understand the dynamics of that particular part. Thank you.
So Nikhil, the capitalization during the quarter was about 5 crores, taking the total capitalization to about 27 crores. Now these projects, the way it have works is that they are built in a phase-wise manner, and as and when a particular phase gets completed, that particular phase starts getting depreciated in P&L over the estimated useful life of the asset. At this point of time, I think sometime in possibly in say first quarter of next year, some of these particular existing capitalizations should start getting expensed over useful life of whatever 2 to 3 years.
Understood, Abhishek. Thank you and good luck for next quarter.
Thank you.
Thank you. We have our next question from the line of Mohit Motwani from Nuvama. Please go ahead.
Hi, thanks for the opportunity. My question, Abhishek, is on the paid campaigns addition. You have been doing a lot of good paid campaigns due to the monthly payment plans. Now, just wanted to understand, are there any 3 to 4 verticals, which are actually helping you, grow your paid campaigns very healthily? Are there 2, 3 verticals that you want to call out? Just wanted to get some insights on that. Thank you.
So Mohit, paid campaigns, even historically for us, no single vertical, so to say, contributes more than 4 to 5% of our revenues. And even now, in terms of recovery that we are seeing, it is extremely broad-based. So paid campaigns and realizations are hardly 2-3% short of pre-COVID peak numbers, and that gap should get bridged very shortly. And the good part is that both geographically as well as in terms of type of businesses, there is a broad-based recovery.
Thanks, Abhishek. One more question. Just wanted to understand, the paid campaigns that you have added in the last few quarters, which were mostly on monthly, 70% were on monthly. What kind of renewals have you seen in these additions? Can you give some color on that?
So most of these particular uh, monthly plan signups that we do, they in a way sort of get auto renewed. At this point of time, of the overall total paid campaign base that we have, now about 55% of those particular paid campaigns are monthly plan basis. In fact, the key advantage with monthly plans is that it obviously is much more affordable to the customer. There's a uh, every month payout that happens instead of a chunky payout, and that is how it works.
Sure. Thanks, Abhishek.
Thank you.
Thank you. We have our next question from the line of Rishit Parekh from Nippon India. Please go ahead.
Hi, am I audible?
Yes, sir.
Sure. Hi. Thanks for the call. Right. I just had 2, 3 questions. Abhishek, Mani, just wanted to understand when. So we've hired a fair bit of people in the last, I think, 3 to 4 quarters, right? Especially in the sales side, right? So just wanted to understand 3 things there. One, what are the hiring plans? Second, how do we measure the productivity of these employees? And essentially, do you think we're operating at an optimum level in terms of productivity, or there's more to be done going forward, and hence a lot of these, employees will be more productive going forward, and we don't need to hire as much?
So Rishit,
And then I
on
have a follow-up.
hiring, yes. So on hiring plans, you would see that first 3 quarters, or maybe say first 2 quarters of this year, the majority or bulk of sales hiring happened. Last particular quarter, overall headcount of the company has increased by only 2.2% only. So I think the way we are looking at it is that since there is more reception of our particular product, even after taking bit of price hikes, so we would want to sort of, in a calibrated manner, keep hiring, keeping next 2 to 3 fiscal years in mind. Having said that, the current sales strength that we have for the same tenure, productivity levels are already higher versus pre-COVID productivity levels. But for the staff that got hired in last 2 to 3 quarters, they would definitely start yielding much better results after they become, say, 6 to 9 months tenured. So for next couple of quarters, 2 3 quarters, whatever internal targets that we have, the existing sales strength itself should be able to cater to it. But since we are seeing decent uptick in terms of productivity, so we might want to continue hiring at a calibrated pace, not as aggressive as we did, say, in last 3 to 4 quarters.
Okay. And just wanted to sort of understand on the outlook perspective with what you see in the market, right? Is there over, let's say, a 2 year period, 3 year period, do you think you can continue the same pace of paid listing addition, or this is just some of the one-off gains that you lost in COVID and that's come back?
So if you see now for last sort of three quarters, we have been adding 18 to 20, 21,000 paid campaigns every quarter. In fact, the current running quarter, we intend to take our monthly plans up from even 70% to 80% or even higher. The idea is make it as affordable as possible for the SMEs. And the way you can say that in a mutual fund industry, you have that SIP book. Uh, in a similar way, we would want SMEs to sort of see their particular 1,500, 2,000 rupees spend on Just Dial as a mandatory spend for their particular business. And since
Plus,
we are seeing
yeah, good, good.
and since we are
Continue.
seeing a positive response on that, I think paid campaigns should keep trending upwards. And again, going forward, whatever revenue growth that we will target, internal target would be half of the growth should materialize from paid campaign growth, and rest half should be we should be able to take corresponding price hikes. That is what
Correct.
demonstrates the true potential of the product.
So you have to understand the opportunity is different post COVID. Post COVID, small businesses and medium businesses are now realized digital first should be the strategy, not like traditional media, traditional platforms are now getting second priority. So hence that priority shifting to digital first, we are going to be one of the beneficiaries. That's because of that we are able to price it better, and we are likely to get more number of customers, advertisers. So this probably explains to you that in the next probably couple of years we see continuous growth both in the number of customers and unique customers, and as well as average ticket size.
Sure. That is very useful. Can I ask one more question, or should I get back in the queue?
Sure. Go
Okay.
ahead.
Just on the newer initiatives, right? I think so. Could you just help us understand where the progress is today broadly? And is there a timeline that is sort of useful for us to monitor the progress or the launch deadlines, let's say over a year
Yeah.
or a 2 year period? Again, I'm not asking for a specific quarter, but again, anything just to understand how should we look at it?
So JD Experts, the pilot has been very successful. We are all set to, accelerate. Probably, hopefully, by the end of next quarter, we should be, full-fledged, accessed by people, users from multiple cities. Uh, Regarding JD Mart, there are certain important feature development and all that being done, and there is renewed focus from the management team, and you will see that fruits of that also shaping up around the same time. As far as JD Shopping is concerned, as I explained to you, that project we didn't want to prioritize, although we invested a lot of money and resources in it, and we continue to capitalize it. We just want to delay the launch because there is no immediate urgency to get that rolling, which is the shopping thing. Because of the
Sure.
3P, 1P marketplace, confusion that existed before, it's no more there. So as a group, as a Reliance company, we said like, let Jasdal focus on all the core services and B2B activities, and then look at shopping as the last priority.
See, also just to add
Perfect.
one point here on JD Shopping, the way ecosystem is shaping up. So suppose you sell a 100 rupee product on your platform, your commissions broadly are in the range of anywhere 7 to 8% on an average, depending on which category you operate in. Now, we did certain pilots, and ideally as a business I would want all my expenses, including my performance marketing spend or any advertising spend, to be curtailed in that 8%, so that over long run it becomes a healthy unit economics business. At this
Correct.
point of time, for us that seems sort of difficult basis whatever pilots we have done, and we see that others in the industry are also obviously unable to operate on a positive unit economics. So consciously we want to be sure that we don't end up spending. You can spend tons of money at the end of day, you will not have that much sticky users. So we want to be sure that we keep improving our platform and at the right time do those particular spends to scale up traffic. So I thought we'll add this.
That's right.
No, that is very useful. Yeah. Thank you so much. All the best, guys.
Thank
Thank
you.
you.
Thank you. Participants, to ask a question, please click on the raise hand icon available on the toolbar, or you may click on Q&A icon to raise hand. We have a question from the line of Vivekanand Subbaraman from Ambit Private Limited. Please go ahead. Mr. Subbaraman, please unmute your audio and go ahead. Can you please unmute your microphone from the toolbar? Since there is no response, we'll move on to the next question from the line of Hemal S, an individual investor. Please go ahead.
Yeah, hi. Can you hear me?
Yes.
Hi. Just have two quick questions. Maybe I just joined the call late. Maybe you already addressed it. What is the total collection amount? Every quarter you used to give the collection amount. What was the collection amount this quarter?
It was 245 crores.
And what was it last quarter?
Last quarter was about 230 crores, and same quarter last year was 150 crores.
Okay. So quarter on quarter, I'm seeing like active paid campaigns and growth slowing down. Is that a concern for you, or is it just the seasonality? Or is that not a concern for you?
So we added about over 18,000 campaigns, and as I mentioned in my opening remarks as well, October, which was a typical festival month, so their part of the additions that were lesser than say 20,000 run rate was attributable to that particular month. So overall, the exit run rate was quite healthy. I think as we go into future quarters, we should continue to see healthy additions.
So festive seasons like Dashera and Navratri, Dashera, Diwali is usually the lowest ever month for Just Add, in a 12-month calendar year. So that's when the both acquisition of customers and revenue dips, but then it picks up. So and usually the March, the last quarter is the best quarter.
Thank you for that clarification. One more is when you say unearned revenue 402, the way you had explained 2 quarters back is what you see this year is generally what you should expect 6 months down the line. Is that still accurate? Is that my understanding accurate?
So it's actually
So
a 12-month down the line, I think. Oh, so go ahead.
Yeah, so 402 crores is advances that I have received from my customers for which services are yet to be rendered. So this 402 crores, the average amortization schedule could be say around 8 to 9 months. Over next 8 to 9 months, this 400 crores will get accrued. Having said that, in those 8 to 9 months, I will also sign up customers and get collections. A part of it would obviously get accrued in that period also. So this quarter's 221 crores, part of it came out of unearned revenue as on 30th September, and part of it came from fresh collections that I received during last particular quarter itself.
Got it. And absolutely final. Since we have such a large cash amount, is it what is an average yield that we should expect for FY24? Like I know it's published, but
About
I'm asking.
7.3%. So portfolios yield to maturity at this point of time is around 7.3%, 7.2 to 7.3%.
Okay, and we can say the duration around 5 years. Is that what?
No, so we operate at a duration of about 3.2 years, primarily because all mutual fund investments become tax efficient as soon as 3 years are crossed.
Okay, perfect. Thank you. I appreciate it.
Thank you.
Thank you. We have our next question from the line of Vivekanand Subbaraman from Ambit Private Limited. Please go ahead.
Hi, thank you for the opportunity. I have two sets of questions. One is on operational numbers and financials. So, Abhishek, need your help on the split of the revenue and campaigns, top 11 versus rest of the market. That's one. Second, if you would help us with the ANP and the guidance for 23 and 24. And last financial question is on the estimated realizable value of collections. I think now that 70% of the collections are for monthly campaigns. How do I make it equivalent to what you were reporting pre-COVID? Last question is on a slide that you have put this time on enhanced analytics for customers. So here, what exactly are you doing, and where have you progressed in this regard, and how will this help you, in your business and monetization? Thank you.
Okay, so Vivek, on your first query, top 11 cities, they contributed about 62% to revenue and 42% to paid campaigns. So essentially, ticket size in tier 1 is higher than tier 2, tier 3. That is why higher contribution by value, lesser by volumes. ANP guidance. So in a steady state, we would want to spend, say, around 6 to 7% of our top line on advertising spends. This particular year, we spent more on ramping up our particular sales teams, etc. Part of those spends got offset by lesser ANP spends. Having said that, pre-COVID, we used to get about 158 to 160 million quarterly users with about 18 crores of quarterly spend. Right now, last couple of quarters, I've been at about 156 million or so, with just about 5.5 crores of quarterly spend. So net ANP spends can be ramped up at any point of time. For next year, as I said, that I will budget in something around 6-7%. On your third question around the estimated realizable value, so last quarter, uh, it was about 260 to 65 crores, very slightly short of 270 crores the previous quarter. The way we look at realizable value is that this is my current estimation. This is the amount of money that I should ideally be receiving in next 1 year from my customers. And this we keep backtesting over our historic data. So whatever I had estimated last year, same quarter, I did almost end up receiving that much amount over the next 12 months. Pre-COVID, this used to be peak of about 235 crores or so. So we are about broadly 15 to 18% higher versus pre-COVID levels. Certain months are even higher versus 20% higher versus pre-COVID. On your query around enhanced analytics, so when we run campaigns for our customers, we try our best to give them visibility on how their campaign is performing. So they get visibility in terms of their listing showing up, searches happening for their particular specific listing, for their category, clicks happening, calls coming to them, request for quotes going to them. So this particular analytics section gives them complete visibility on how their campaign is performing on a monthly basis, etc. So we have added new features such as giving SMEs ability to sort their particular leads by relevance, sort their leads by recency, trying to give them as much control as possible on their particular campaign so they can make best use of whatever visibility that we provide them. And over time, this simplicity and being able to track performance of their campaign directly correlates with how my renewals pan out, how my customers perceive ROI from my platform.
Okay, makes sense. So, Abhishek, thank you for all the answers. Just one follow through. So, the realizable value of collections is 260 to 265 crore in 3Q. Would you be able to help us with the number for the last 12 months? Because this migration to monthly packages has been underway since the COVID recovery. I'm just trying to understand because
So
the reported numbers are still lower than COVID, but in FY24 you might suddenly have a sharp jump in revenue, basis what you just commented right now.
So for first 9 months of this year, first 3 quarters, realizable value was broadly around 765 to 770 crores. I tend to give a range because it's a estimate. So 765 to 770, and the same for first 3 quarters of last year was about 435 to 440 crores.
435 to 440 crore. Okay. So
Yes, because
essentially,
last year, obviously, there was significant impact of COVID in first 1 or 2 quarters.
right, right. So essentially, Abhishek, if we end up with, let's say, realizable value of collections broadly similar to what we saw in 3Q, um, is it fair to assess that the fiscal 24 revenue number will be 770 plus 260, so around 1000 crore? I'm just trying to understand because the percolation to revenue has been difficult for us to model.
Okay, so technically, if I were to understand, see, whatever I will sell in next particular quarter, those customers will pay me the signed amount over a period of next 12 months. Okay.
Yes.
And whatever that particular money comes in will get accrued over their respective tenures. So it might not one-on-one correlate. So the first 9 months amount, yes, with the great certainty I can say that yes, that will surely get accrued as revenue in fiscal 24. For last 3 to 4 months, a part of it could sort of spill over.
Okay, understood. This is very helpful. Thank you and all the best.
Thank you.
Thank you. We have a next question from the line of Rupesh Tatia from Intel Sense Capital. Please go ahead.
Hello, sir. Can you hear me?
Yes, please go ahead.
Yeah, I am relatively new to the company, so some of the questions might be slightly basic. So my first question, sir, is I mean, do you have a margin guidance for us, let's say in FY24, or when we can get back to, let's say, pre-COVID margins, and how do we get there?
So in terms of, we do not per se provide a specific margin guidance, but pre-COVID we used to operate at around 25 to 28% sort of margins. We are obviously coming out of this particular COVID impact in terms of our top line trying to catch up with the pre-COVID numbers. As far as expenses are concerned, we have already made significant investments in terms of ramping up our particular sales team. So I think next year, same quarter or thereabouts, we should be sort of on a quarterly basis be coming closer to pre-COVID type of margin levels, or could be slightly earlier as well.
Okay, okay, that is good to know, sir. The second question I have is like I think the pre-COVID your active campaigns were around 520K, and I think we've reached that number, in this quarter, and this might be the easy part. I mean, whatever we lost, some of our customers were impacted in COVID. They are now coming back. So, and you have done so much hiring and so much investments into the business, right? And you are now saying that we'll grow pretty much, you will add 20,000 pretty much every quarter, more or less. And plus, you will continuously grow now for next, let's say 6 to 8 quarters. So can you give some, second level details around that? Because till here, I think the journey at least was relatively easy in my mind. How do we go from here, from let's say 520K to let's say 700K in next 6 to 8 quarters?
Okay, so let us look at it slightly from a top-down perspective. So India broadly, basis ministries estimates itself, has about 65 million small and medium businesses. Another 15 to 20 million could be freelancers such as gym instructor, yoga teacher, swimming coach, etc., which are not technically SMEs, but they're potential listings for us. So broadly, the universe could be say 80 million listings. Now, post COVID, I would argue that against this particular 80 million listings, For sure, 1% of this particular universe should surely be at least advertising on a platform such as Just Dial. That itself translates to, say, 800,000. My database at this point of time is about 35 million listings. In a steady state, we think that 5% of the database should surely be our particular paid subscribers. So that way, that translates to sort of huge opportunity numbers in terms of a million plus or close to 1.5 to 2 million subscribers. So there is no dearth of opportunity per se. Good part is that COVID in itself has made SMEs realize that they need to be present on online platforms from where they could get their particular business to get discovered. During COVID, SMEs which had some online presence could still cater to getting some particular consumers. But ones who were completely offline, they do realize that the way it is important to have an internet connection for your business, a telecom connection, similar way you need to be present on an online platform. Plus the average ticket size of 18 to 20,000 rupees that we charge annually, that overall we feel is very, very affordable for any small and medium business. It's not an amount which will pinch any particular SME's affordability.
Okay. That's clear, sir. The another part of the question is you have talked about price hikes and let's say, I mean, whatever your first batch of monthly customers, maybe they are now, I don't know, 18 months old or maybe more than 12 months old. What kind of price hikes we have been able to get this, or if you can talk about behavior of this cohort in terms of, I mean, they're going into longer plans, are they converted into ECS, what kind of services they're using, if you can give some color on that cohort, for example.
Okay, so even today or even before we adopted this particular aggressive monthly plan strategy, we still had a good chunk of customers who have been paying us on a monthly plan basis for last several years. Why I'm emphasizing this particular point is that for me, it is important that a particular customer should keep paying me on a month on month basis. I am not that obsessed about getting that extra 10-12% price hike from that particular customer. In any case, for a digital advertising platform, there will be customers who might choose not to renew on an immediate basis, etc. So whatever new customers that are coming in, they tend to obviously face price hikes. Customers who have paid in lump sum, whenever their next renewals are due, they also obviously face price hikes. So overall, the target is that part of the growth on the overall cohort basis should come via price hikes that we can take. So I'm not that worried about whether a customer who signed up 15 months ago and they are happily paying me 2200 rupees a month, whether I should work to get 2400 out of that particular customer or not.
Okay, so I mean, what kind of price hikes we do? 5% or 10-15%? Is it, I mean, what kind of
Okay,
range?
so there are two types of listings that we sell. One is the premium listings, other is the non-premium listings. Premium listings are the top fixed positions. So if you're searching for, say, dentist in Bandra West, the dentist coming on top, they have typically blocked that inventory for all for the entire tenure. So if 100 searches are happening, their name will come on top position in all the 100 searches. Post those premium listings, rest of the customers get visibility in proportion to the money being paid by them. There is no fixed position. Now in premium listings, there is a scientific way by which price hike gets percolated. So the way it works is that for categories which are seeing growth in traffic, part of the growth in traffic gets percolated as price hike every month. So whenever a particular customer comes up for renewal, say at the end of their particular tenure, they see a certain price hike. This particular model also helps us to sort of reduce prices in those categories which are not in demand. So that way, if a particular category is seeing, say, 10% drop in traffic, we are happy to pass or reduce prices by, say, 6% or whatever part of that growth or degrowth. On the non-premium listings, we take price hikes from time to time, which is where we took about 12 to 15% price hike sometime in second quarter of this particular year.
Okay, okay, I see, I see. Then one small question. I mean, in terms of, sales employees, can you talk about, I don't know, capacity utilization? I know you say that some of these people will start, contributing 9 months forward, but in terms of, I don't know, capacity utilization might not be the right word, but you get what I'm asking.
Okay, so the way we sort of evaluate is we look at something known as uh, gross margins or gross sort of cost of sales, which is nothing but direct costs associated with sales, such as salaries and incentives that we do our sales employees. So at this point of time, we are operating at about 47-48% being our cost of sales. And pre-COVID, during our best months, we used to operate at about 40% or so. Now, this 48% obviously is higher, partly because there is a significant hiring that has happened. So on the financial side, I would obviously want this 48% to go towards 40%. And at the same time, as far as potential in terms of output or productivity is concerned, uh, definitely on an overall basis, there is still potential to improve their particular productivity by 20%, 30%, if not more.
Okay, okay, I see. And then the final question, sir, is in terms of, competitive positioning post the, acquisition by Reliance Group. I mean, can you give some color on in certain areas, we have got maybe some areas where we were trying to work really hard in the past, but we weren't able to get success now with the help of Reliance. In some of these areas, we are becoming kind of leaders. And then what are some areas where, there are still kind of areas of improvement? If you can, talk about competitive landscape post Reliance takeover.
Okay, so there, instead of specific areas, I would say our strength is in being a horizontal. So the key strength of the platform is that one platform which connects all these small and medium businesses in India. You search for any particular category, you will surely find relevant results. The depth and breadth of results is far superior on the platform. Over last few quarters and in coming quarters, what you will see, the same set of database will have much richer content in terms of you being able to see deals and offers being offered by some of these particular businesses, their particular tariff cards, menus, catalogs, basically a much more curated content which will enable users to take much better decisions which particular SME to avail services from, and so on. So overall, instead of pre-Reliance or post-Reliance, I would say that as far as core business is concerned, that is more to the strength lies in being horizontal, very well-oiled sales machinery, the network that we have pan-India. In terms of newer initiatives which pertain to adding a transactional layer, both on the services side as well as on the product side, that is where we are working closely with the Reliance team, and those particular initiatives are underway.
Okay, okay. Thank you so much, sir, for answering all my questions.
Thank you.
Thank you. We have a next question from the line of Amarnath Bhakat from Ministry of Finance of Oman. Please go ahead.
Yeah, hi. I hope I am audible.
Yes, sir.
Yes, please go ahead.
Yes. Uh, just two small, again, the strategic follow-up questions on this. After Reliance get into your business as a promoter, now is there any strategical change happen to the business? Say now they came into of their way of looking at the business might be different than the just dial working before that. So if you can help us to understand, is there any major strategic outlook change after the Reliance comes to the board?
So in terms of strategic change, I would say that the key priority was that we had two successive years of COVID impact in terms of say our top line going down by about 32% versus pre-COVID levels. And the clear strategic discussion that we had was that how can we, in this particular fiscal 23 itself, quickly bounce back to pre-COVID levels. So while the P&L revenue will take another quarter or whatever to catch up, but we have been able to, the fact that we have been able to cross pre-COVID levels of realizable value, collections at 244 crores are anyway higher versus 235 crores of pre-COVID revenue.
Abhishek, I'm not looking at the operational factor. See, whether Reliance is there or not there, the operational recovery post-COVID, it is even to be bound to be happened. That is just a matter of time, whether 6 quarter or 8 quarter or 2 years or 3 years. I'm just trying to
Right.
understand from a strategic point of view, the way the company was working before Reliance came in, and after the Reliance took over the majority stake, of course, there must be something strategical outlook change. That okay, now the new promoter came, they want that business to be run in a little different way or something in a new direction. I'm just trying to understand that is there any directional change happened in the company after the Reliance came into picture, not the operational part of it.
Okay, so as I mentioned earlier, the directional change primarily is to say that this particular platform is a search discovery based platform. Can we add a transactional layer because things are obviously moving online? Having said that, those particular transactional layer, we are also very clear that we should not be doing something which just results in bleeding of money because something does not seem to have unit economics in the long run. So some of our newer initiatives are clearly an outcome of those particular strategic discussions, which are to say that add a transactional layer such that SMEs which were getting discovered on the platform earlier, can interactions between the user and that SME also get routed via the platform itself?
Okay, so it is more of an integrated approach rather than and piecemeal approach probably, because now you wanted to have an app which is integrated in nature from top to bottom. So once the SME comes into your platform, they will start from searching up to the end of payment and delivery.
Right.
So in
Am I
certain
understanding right?
categories,
Yep.
yes, so in certain categories, up to till the end, in certain categories, it could be enabling digital payments. So even if there is a transaction happening in an offline store, can the payment be collected via a particular platform? So yeah, that is how it is.
Okay. Is there any change in the top management or the organization structure after this deal happened? Any new management staff? I'm talking about the top management staff either came in or came out, or somebody is about to came in, something like that in the top management. I'm talking about CEO minus one.
So at management level, there haven't been any changes. At board level, we recently inducted two new directors, which were announced as part of last board meet.
Okay, so management was as it was before this acquisition took place.
Yes, even as part of our discussions, Reliance Group was very clear that they would want the existing management itself to take over and keep running the business, which is how it has panned out.
Okay, and the last piece of it, bit operational. Now the hiring spree in the last few quarters is suddenly seriously accelerated. Of course, we all understand that at some point of time, the return will come, and it is fixed in expenditure for which the operating leverage will play out at some time. Just trying to understand why that was so much of recruitment happened almost in a 1 quarter or 2 quarter rather than on a staggered manner as and when business recovered and as and when the operating leverage from the existing staff are getting factored into the P&L and the balance sheet.
Okay, see, let us understand when I hire, say, 100 sales employees, they take anywhere around, say, 4 to 6 months to start producing some decent revenue, and they reach their particular peak productivity in, say, 12 months time frame. Now, if I were to follow this particular approach to say that, okay, I will hire 500 people, I will wait for them to become optimal at the end of 9 months, 12 months, I would unnecessarily end up losing time. So what we did was, once we fine tuned our strategy to say that, okay, we will aggressively focus on selling monthly payment plans, we saw productivity of existing team itself was ramping up. That is when we went about hiring, aggressive hiring. That aggressive hiring also, in my view, already was done in a staggered manner. It was not one particular single quarter where we hired over last 4 quarters. So that was already phased out.
So, as an investor, so probably we should read into in that as a management, you are confident that even if the hiring spree was accelerated in the last 3 4 quarters, the utilization maximization will eventually happen, and the idleness of the existing staff will not hurt your margin profile going ahead.
Yes, whatever is the cost structure, see, whatever people I hire, their salary costs have already hurt the P&L, so to say. Now, going forward, whenever the top line starts to show up in P&L, those margins should automatically see expansion. Internally, the way I look at it is, the 190 crore cost structure that I have today on a quarterly basis, on P&L basis, it shows up as 221 crores of top line. But for me, that 190 crore fetched me 245 crores of collections and 265 crores of realizable value. So in a way, that particular margin profile is already better versus what gets reported. P&L margin is obviously with a lag. That 221 crore is coming from customers whom I had sold in last 3 to 4 quarters, but my costs are already getting amortized on a monthly basis.
Thank you. That's it. Thank you very much. It's like
Thank
the
you.
confidence of the management. Thank you.
Thank
Thank
you so
you.
much.
We'll take our last two questions. We have a question from Vivekanand Subbaraman from Ambit Private Limited. Please go ahead.
Hi, just one question. Abhishek, have you spoken about this, the headcount that you have deputed to some of these projects that are under development? Just to unpack the headcount question better.
So the headcount attributed to some of these projects, that is not very high at this point of time, would be say sub 200 or so, but I'll have to check on exact numbers.
Okay, and are these staff members, fungible in terms of, can they be reassigned to, for example, JD Shopping, you guys took a call that perhaps the regulations and the extent of cash burn needed doesn't entail a very aggressive push. So, are you reassigning these people to the core business itself? Is that how you are carrying it out?
Yes, that is very much fungible. The straightaway proof is that this particular quarter, while total headcount addition was 300 employees, my sales count addition is already 600. So some of those particular employees, we found it prudent to reshuffle and reassign to our core business.
Right. And last quarter, I believe you had mentioned that you have around 600, 650 people in JD Mart. Is that the same, or have you added any more people there?
So that stands at broadly around 750 or so at this point of time.
All right. Thank you very much, and all the best.
Thank you.
Thank you. We'll take a last question from Sarang Sanil from RW Investment Advisors. Please go ahead.
Good evening, sir. Congrats on good set of numbers. So a couple of questions. Could you give a breakup of revenue and paid campaigns into tier 1 and 2, 3?
So tier one cities contributed about 62% to revenues, and by paid campaigns, they contributed about 42%.
Okay, so that's broadly the top 11 cities, is it?
Yes, top 11 cities.
Okay, understood. Okay. So one thing I don't understand is that so I posed as a seller and I experienced, so I tried calling JD and everything. So so I tried with multiple cities, and the minimum subscription cost for a city called Coimbatore, which could probably be a tier 2, tier 3 city, the minimum subscription fee was 3,000 rupees. And some place like Bangalore, the minimum subscription was 4,000 per month. Okay. I don't understand how annually it turns out to be rupees 20,000, 18 to 20,000 on paper, while when we analyze the monthly thing, it is around 48, 45 to 40, 50,000, right? So is it because a lot of people are dropping out?
Okay, so couple of points there. One, the average ticket size that you see is on a blended basis for Pan India, and tier one cities typically are about 30-35% higher, whereas the other smaller cities are at a lower price point. Secondly, this particular pricing also tends to be customized at a category level. So no, not all uh, customers of across the city will face similar pricing.
Right,
So
right.
once our particular feet on street comes up, they understand what are your keyword requirements, which all geographies you want to target. Basis that they propose the relevant pricing.
Understood. So could you give us an average, say, ticket price for tier 1 city or tier 2, 3 city?
So as I said that in case of, let me check, I might have it handy. Tier 1 cities versus the average, it is about 30% higher.
Right, right. No, and absolute.
Absolute, I will have to check, should be around 26-27,000 rupees or so.
Okay, so that's like roughly 2,000 rupees per month
Yeah, 2,200 rupees per month on an average.
for a tier 1 city, is it? Okay. Okay. Also, a follow up on the same. So, what percentage of overall paid campaigns stay for a year or more on an average
What percent of, sorry?
of the overall paid campaigns? Say we have about 5.2 lakh, right? So, how
So
many of them actually stay for a year?
So historically, the churn rate that we have had, which we see as if 100 customers signed up today, how many go into year two, exactly 1 year down the line, that is around 55% retention, say around 42% do not go into year two. Having said that, in our particular case, which we have discussed multiple times in the past as well, a particular customer wanting to pause their campaign after a period of 1 year does not mean that they have churned out for life. Advertising tends to be a slightly discretionary spend where a person might think that, okay, let me pause the campaign for 3 months, see how my business is doing. 3 months later, 6 months later, they might want to come back into the paid ecosystem with higher or lower spends. So the way we look at it is, I mean, overall, how many particular customers that we are signing up rather than, okay, just after 1 year, how many are going into year two or not.
Hmm. Okay.
For
Understood.
example,
Understood.
during the COVID period, customers who say churned out that particular year or did not renew, a good chunk of them are coming back into the paid ecosystem today.
Okay. Got it. Also, one more thing. So, from my experience, you don't give any discounts for customers paying upfront annual fee, right? Why is it so? Say a B2B player like IndiaMart typically gives out a discount for paying upfront.
Okay, so this was a intentional strategic call that we took. We did used to give some particular discounts for upfront payments, a certain say cash discount, which sounds logical as well. But then what we realized was that in those particular situations, at times there tend to be bit of miscommitments because the salesperson is wanting to get the lump sum money upfront. So we said that we anyway as an organization are keen to sign up as many customers on a monthly plan basis. We actually do not want customers to pay up on a lump sum basis upfront. We want those particular customers to pay us on a monthly basis and keep paying us for a longer time frame. So that is the reason we decided that, okay, let us withdraw those particular discounts on upfront plans. Having said that, our particular branches do have a discretion to run some short-term offers that they might want to do, which
Okay.
is a
Okay.
key feature in any business.
Sure. Sure. Understood. Understood. All the best, sir. All the best. Thank you.
Thank you.
Thank you. I would now like to hand the conference over to Mr. Abhishek Bansal for closing comments. Over to you, sir.
Thank you everyone for joining us. In case you have any further queries, please do reach out to us. We would do our best to address, and that's it from our side. Thank you.
Thank you.
On behalf, thank you, sir. On behalf of Just Dial Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.